Welcome back to the Pro Ticker Podcast. It's your Friday morning edition, covering major financial magazine headlines, everyone. We've got a lot to unpack today, from Apple's latest earnings to a
Oh, yeah.
Chinese AI startup that's sending shockwaves through the tech world. So
Wow.
grab your coffee and buckle up, because we're about to take a deep dive into the wild world of global finance.
I think it's fascinating,
Yeah.
how seemingly unrelated events can have a ripple effect across markets and industries. And today we'll explore how those ripples are playing out in the AI landscape, international trade, and even your Super Bowl guacamole.
Speaking of guacamole, let's start with a company that's probably a little too familiar to all of us, Apple. Bloomberg is reporting that they just announced their fiscal first quarter results, and it's a bit of a mixed bag. While their overall revenue is up, iPhone sales dipped slightly, and their revenue from China took a significant hit, down 11% to be exact.
That dip in Chinese revenue is particularly interesting, especially considering the context of Apple's AI strategy. The Wall Street Journal notes that the iPhone 16 family, the first to incorporate Apple's AI tools, hasn't sparked a significant upgrade cycle.
Yeah. It does make you wonder, are people just not that excited about Apple's AI offerings? Bloomberg even points out that Apple Intelligence, their AI platform, isn't even available in China yet. Could this be a sign that they're falling behind in the AI race?
Especially against local Chinese brands?
It's certainly a possibility. Think about it. When was the last time a new iPhone release felt truly groundbreaking? Perhaps Apple has become too reliant on hardware sales, and their AI integration hasn't been compelling enough to drive a major upgrade cycle.
Right. And while we're on the topic of AI, there's another story that's impossible to ignore: the rise of DeepSeek, a Chinese AI startup that's making waves and triggering some serious market jitters. Bloomberg reports that their cost-efficient AI model, R1, is rivaling U.S. offerings in performance, and that has triggered a $1 trillion market wipeout. Wow. This development has sparked concern about the effectiveness of U.S. attempts to restrict China's access to advanced technology. Bloomberg even reports that U.S. officials are investigating whether DeepSeek circumvented export controls by acquiring NVIDIA chips through intermediaries in Singapore.
So it's like a high-stakes game of technological chess. And what's even more intriguing is that NVIDIA, a key player in the AI chip market, insists that its partners comply with all applicable laws and is cooperating with the investigation. What do you make of this, given the current geopolitical climate?
It's a complex situation with potential ramifications for the future of AI development and competition. If DeepSeek is found to have bypassed export controls, it could lead to further restrictions and escalate tensions between the U.S. and China. On the other hand, if NVIDIA's partners are cleared, it raises questions about the effectiveness of current export control measures.
Yeah. It seems like the AI landscape is shifting rapidly, with new players challenging the established order. Now let's shift gears a bit and talk about global economic trends. Bloomberg reports that French inflation held steady in January, prompting traders to anticipate European central bank interest rate cuts. Meanwhile, U.S. inflation is expected to tick up slightly, potentially keeping interest rates higher for the time being.
Interesting. This divergence in monetary policy between major economies could have significant implications. For currency markets and global investment flows, we're seeing a potential scenario where the euro weakens while the U.S. dollar strengthens, which could impact everything from import and export prices to the cost of travel.
Right. And speaking of things that could impact your wallet, let's talk about President Trump and his penchant for trade battles. MarketWatch reports that he's announced his intention to impose 25% tariffs on imports from Canada and Mexico, starting Saturday, citing immigration, drug trafficking, and trade deficits as reasons.
This protectionist move has the potential to exacerbate trade tensions with two of the U.S.'s largest trading partners. It's a bold move that could lead to retaliatory tariffs and disrupt the flow of goods across North America.
And if you're a fan of guacamole, get ready for some sticker shock. Bloomberg reports that these tariffs are likely to hit avocado prices particularly hard,
Yes.
just in time for the Super Bowl. Looks like those Super Bowl parties might be getting a little more expensive this year.
Yeah. This really highlights how political decisions can have a direct impact on our daily lives, even when it comes to something as seemingly simple as avocado prices.
Absolutely. It's a reminder that everything is connected, and political decisions can send ripples through the global economy that affect us all. And speaking of those ripples, CNBC reports that gold prices have surged to an all-time high, due to the uncertainty surrounding these new tariffs.
Right. That's a classic safe haven play. When investors get nervous
I've heard of
about
it.
global stability, they often flock to assets like gold, which are perceived as less risky.
Okay, so now let's dive into what's happening in the financial markets themselves. The Wall Street Journal is reporting that. Despite Wall Street doing quite well, loan growth at U.S. banks is actually pretty sluggish, especially for regional lenders.
This raises an important question. Is this a sign of underlying weakness in the broader economy? Or is it a reflection of a shift away from traditional bank loans towards other forms of financing?
The Wall Street Journal seems to think it's a worrisome trend either way, potentially signaling that businesses are hesitant to invest, or that the landscape for how companies access capital is changing.
Right. It's definitely something to watch closely in the coming months. If loan growth continues to stagnate, it could have negative implications for economic growth.
Now, amidst this lending slowdown, Bloomberg is reporting that JP Chase just pulled off a very successful $3 billion preferred stock sale.
What's particularly interesting about the sale is that they offered a higher coupon rate to attract investors, and it seems to have worked beautifully.
So what's the takeaway here? Are investors simply hungry for yield in this low interest rate environment?
It's certainly a major factor. With interest rates expected to stay low for the foreseeable future, investors are increasingly searching for investments that can provide them with a decent return.
And JP seems to have understood that perfectly. They tapped into that demand by offering a higher coupon, and investors clearly responded enthusiastically.
Right. This strategy highlights how financial institutions are adapting to the changing market dynamics. They're having to get creative to attract investors and manage their capital in a low interest rate world.
And in another example of navigating a complex world, Bloomberg also has a report about Goldman Sachs finally managing to sell its business in Russia. Apparently, President Putin himself gave the green light for the sale to an Armenian investor.
This is a significant development, as it's one of the few instances of a Western bank successfully exiting Russia since the invasion of Ukraine.
Yeah, it really underscores the challenges and complexities of doing business in a geopolitical environment fraught with sanctions and political risks. It seems like companies are having to make some very difficult decisions about where they operate and how they manage their exposure to these kinds of global risks.
Absolutely. The world is becoming increasingly interconnected, but also increasingly fragmented. Companies and investors need to be nimble and adaptable to navigate this new reality.
Speaking of navigating a new reality, let's circle back to Apple for a moment. Bloomberg notes that they're facing challenges, not just in China, but also potentially here at home, with the possibility of new tariffs in the second Trump administration.
Right. This adds another layer of uncertainty to Apple's outlook. They already rely heavily on global supply chains. With most of their processors made in Taiwan and their devices assembled in China, new tariffs could disrupt these supply chains and increase costs for Apple, potentially putting a further squeeze on their profit margins.
And Bloomberg reports that Apple CEO Tim Cook is monitoring the situation, but hasn't offered any specific plans on how they might adapt. Do you think Apple is adequately prepared for the challenges ahead, especially in the rapidly evolving world of AI?
That's a question many analysts are grappling with. While Apple Intelligence has some interesting features, they're playing catch-up in a field that's evolving at breakneck speed.
Right. Bloomberg even highlights that Apple Intelligence isn't yet available in China, putting them at a significant disadvantage against local competitors like Huawei.
And let's not forget DeepSeek. They've raised the bar for cost-efficient AI, putting pressure on established players like Apple to innovate faster and more aggressively.
So Apple is facing a multi-pronged challenge: intense competition in the AI space, potential disruptions to their supply chains, and the need to adapt to a world where software and services are becoming increasingly important. What do you think? Can they keep relying on their hardware sales, or do they need to make some bolder moves?
That's the million-dollar question. Apple has a history of innovation and a loyal customer base, but they can't afford to rest on their laurels.
They've always been known for their sleek designs and user-friendly interfaces. But those might not be enough in a world where AI is becoming the defining technology.
Exactly. Apple needs to demonstrate that they're not just a hardware company, but a leader in the AI revolution. Whether they can pull it off remains to be seen.
And it's not just Apple that's grappling with these AI disruptions. Bloomberg also reports that Microsoft is feeling the heat from DeepSeek. They're actually investigating whether a group linked to DeepSeek improperly obtained data from OpenAI, one of Microsoft's key AI partners.
This adds another layer of intrigue to the story. If DeepSeek is found to have accessed OpenAI's data improperly, it would raise serious questions about intellectual property theft and could further escalate tensions between the US and China in the AI arena.
It's like a real-life technological thriller. This situation highlights the incredibly high stakes involved in the race for AI dominance.
Absolutely. The competition is fierce, and the lines between collaboration and competition are becoming increasingly blurred. It's a fascinating and dynamic landscape that we'll be keeping a close eye on.
And speaking of keeping a close eye on things, CNBC has a report on a completely different kind of challenge: the impact of President Trump's tariff threats on currency markets.
Right. This gets into the fascinating world of Forex and how political events can send ripples through the global financial system. It's a reminder that seemingly isolated events can have far-reaching consequences.
CNBC says the dollar actually jumped after Trump announced those tariffs on Canada and Mexico. Is that a typical reaction?
It's not entirely surprising. When there's uncertainty in the global economy, the U.S. dollar often acts as a safe haven, attracting investors seeking stability.
It seems a bit counterintuitive, though. The more uncertainty Trump creates with his trade policies, the stronger the dollar becomes.
It's a complex interplay of forces. On the one hand, tariffs can hurt U.S. businesses and consumers, potentially slowing down the economy. On the other hand, they create a sense of urgency and unpredictability, leading investors to seek refuge in the perceived stability of the U.S. dollar.
It's certainly a puzzle, and CNBC also points out that the Canadian and Mexican currencies took a hit after Trump's announcement. That's not a surprise, though, is it?
No, that's to be expected. Tariffs on Canadian and Mexican imports make their goods more expensive for U.S. buyers, which can hurt their economies and weaken their currencies.
Yeah, it really drives home the point that everything is interconnected. A presidential tweet can trigger a chain reaction, currency markets, impact global trade flows, and even affect the price of your avocado toast.
It's a reminder that in today's world, political decisions, economic trends, and technological innovations can have far-reaching and often unexpected consequences. It's impossible to isolate one event from the global system as a whole.
Now, before we wrap up this segment, I want to touch on a more positive development. Happening across the Atlantic, Bloomberg reports that European stocks are on track for their best month in 2 years. What's driving this surge?
It's quite a turnaround, isn't it? Bloomberg attributes it to a combination of factors, including strong earnings reports, easing concerns about energy prices, and a growing sense that the European Central Bank is nearing the end of its rate hiking cycle.
So maybe things aren't as gloomy in Europe as we sometimes hear.
It's certainly a possibility, and this surge in European markets shows that. There are always opportunities for investors who are willing to look beyond the headlines and dig a little deeper. Sometimes the most promising opportunities are hiding in plain sight.
And that's exactly what we aim to do here on the Pro Ticker podcast. Unpack the complexities of global finance and provide our listeners with the insights they need to make informed decisions. But for now, let's take a quick break. When we come back, we'll wrap things up with some key takeaways from our deep dive and leave you with a thought-provoking question to ponder.
Sounds good. It's interesting to think about how these trends in Europe might impact the global economic landscape. Could this surge in European markets signal a shift in investor sentiment away from the U.S. and towards Europe? It's definitely something to consider as we analyze these interconnected trends.
Yeah, it certainly adds another layer of complexity to the already intricate world of global finance. But speaking of complexity, we can't overlook the ongoing saga of Brexit and its impact on the UK's relationship with the EU. Bloomberg reports that the UK is attempting to renegotiate its relationship with the EU, aiming to strike a balance between closer ties and their commitment to controlling immigration.
It's been a delicate balancing act. Ever since the UK voted to leave the EU, they want the economic benefits of closer trade relations with the EU, but are also wary of the free movement of people that comes with it.
Right. It's a classic case of wanting to have your cake and eat it too, isn't it? They want the benefits without the perceived drawbacks, but is that even possible in this situation?
It's proving to be a difficult challenge. Bloomberg reports that they're considering a scaled-down version of the EU's youth mobility program, which would allow for student exchanges, but wouldn't contribute to net migration. It's a potential compromise. But whether it will satisfy both sides remains to be seen.
Yeah, it seems like domestic political considerations are complicating these international negotiations. It makes you wonder if they'll ever be able to find a truly workable solution that addresses everyone's concerns.
It's a reminder that Brexit is not a one-time event. but an ongoing process with far-reaching implications that we'll continue to see unfold in the coming months and years.
Well, it seems like the only constant in the world of global finance is change and the need to adapt quickly to new realities.
Yeah.
But before we wrap things up, I want to circle back to one last point that we touched on earlier, the role of safe haven assets like gold. In times of uncertainty,
Right, it's important to understand why investors flock to safe haven assets like gold when they perceive increased risk. In the global economy, gold is seen as a store of value that tends to hold its worth even when other assets are declining.
so it's a way for investors to protect their wealth during periods of volatility, like the one we seem to be experiencing right now, with these escalating trade tensions and the emergence of new AI powerhouses like DeepSeek.
Exactly, and CNBC reports that gold prices have hit an all-time high. Due to this confluence of factors, investors are clearly looking for a safe place to park their money as they wait to see how these global trends play out. It's a classic example of how market psychology can drive significant shifts in asset prices.
Okay, so we've covered a lot of ground today, haven't we? We've discussed Apple's challenges in the AI market, the rise of DeepSeek, and its potential impact on the global tech landscape, President Trump's penchant for trade battles, and the implications for the U.S. economy, and even the U.K.'s ongoing struggles with Brexit. That's a lot to digest. But hopefully our deep dive has provided some valuable insights into these complex issues.
I think the overarching theme that emerges from our discussion is that we're living in a time of unprecedented change and uncertainty. The rules of the game are being rewritten, and companies and investors who can adapt quickly and embrace innovation will be the ones who thrive in this new environment.
So what does this mean for our listeners who are trying to navigate this new reality? What are the key takeaways they should keep in mind as they make financial decisions?
I think there are 3 key points to remember. First, diversification is more important than ever. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographic regions to mitigate risk.
That makes sense. Don't bet everything on a single company or sector because you never know what might happen. And what's the second key takeaway?
The second is to stay informed. The world is changing rapidly, and it's crucial to stay up to date on the latest trends and developments in technology, geopolitics, and the global economy. Don't rely on headlines alone. Dig deeper and seek out information from reliable sources.
Knowledge is power, as they say. And what's the final takeaway you'd like our listeners to remember?
The third takeaway is to embrace innovation. The companies and investors who are willing to embrace new technologies and adapt to changing circumstances will be the ones who succeed in the long run. Don't be afraid to challenge conventional wisdom and explore new possibilities.
That's some great advice. So to sum up, diversify your investments, stay informed about global trends, and embrace innovation. These are the keys to navigating the turbulent waters of global finance in this era of rapid change and uncertainty.
Exactly. And remember, there are always opportunities to be found, even in the midst of challenges. It's all about staying alert, being adaptable, and having the courage to embrace the unknown.
Well said. And on that note, we'll wrap up today's deep dive into the world of global finance. We'll see you all tomorrow morning with new headlines from major financial magazines.
Yeah, it really is a fascinating time to be following the markets, you know? The old rules are being challenged, and new power dynamics are emerging. Who would have thought a Chinese AI startup could send $1 trillion ripple through the global market?
Yeah, it's a story that highlights how interconnected everything is these days. A development in the tech world can have ramifications for avocado prices, gold markets, and even the strength of the U.S. dollar.
Exactly. And that brings us back to one of our main themes today, disruption. We've seen it with Apple's struggle to maintain its edge in the AI landscape, and we've seen it with President Trump's trade policies, shaking up the global economic order.
And let's not forget the ongoing Brexit saga, which is a prime example of how political decisions can have far-reaching consequences for businesses and investors.
Absolutely. It's a lot for anyone to keep track of, but that's why we're here, to help you make sense of it all. So as we wrap up today's deep dive, let's distill some key takeaways for our listener.
Sounds good to me. Where should we start?
Well, first and foremost, I think it's crucial to recognize that we're in uncharted territory. The rise of AI, coupled with geopolitical shifts and unpredictable trade policies, is creating a level of volatility and uncertainty that we haven't seen in decades.
So what's the best way for our listeners to navigate this turbulent environment? Any advice you can offer?
Well, I think the most important thing is to be adaptable. and open to new possibilities. Don't be afraid to challenge your assumptions and be willing to adjust your strategies as the landscape changes.
That's some solid advice. What else should our listeners keep in mind?
I think this is a time to be both cautious and opportunistic. On the one hand, it's important to be mindful of the risks and not overextend yourself. On the other hand, there are always opportunities to be found amidst disruption.
So it's all about finding the right balance, being aware of the risks, but not letting fear paralyze you.
Exactly. And that brings us to our final thought for our listeners to ponder as they go about their day. In a world where technology is evolving at an unprecedented pace and the geopolitical landscape is in constant flux, what are the skills and qualities that will be most valuable in the years to come?
That's a great question to leave our listeners with. It's something we'll all be grappling with as we navigate this new era of uncertainty and opportunity. And on that note, we'll wrap up today's deep dive into the world of global finance. We'll see you all tomorrow morning.
With new headlines from major financial magazines.